Hey everyone, and welcome back to the channel. Today, we are diving deep into a stock that's been making waves on the Singapore exchange, Hong Kong land. If you've been watching the markets, you might have noticed it trending. But why? What's driving its recent activity, and is it a good fit for your investment portfolio? Stick around because we are breaking down everything you need to know. If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. But first, a quick disclaimer. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. First up, let's talk about why Hong Kong land was buzzing on the SGX, especially during that week of June 29th to July 5th, 2025. It wasn't just about Hong Kong land itself, the broader market was on fire. The Straits Times Index, Singapore's main stock market benchmark, actually hit a historic milestone, closing above 4,000 points for the first time ever on July 2nd and 3rd. When the whole market is doing well, big established companies like Hong Kong land often ride that wave. But there was more to it. Just before this trending period on June 27th, Hong Kong land was actually the top gainer on the Straits Times Index. That's a huge signal of strong investor interest. We saw massive trading volumes with over 3.8 million shares changing hands and a turnover of over $22 million on June 30th alone. What really fueled the fire was the analyst sentiment. Out of 11 analysts covering the stock, a whopping 7 gave it a strong buy rating. 1 said buy, and only 3 said hold. 0 sell ratings. That's a powerful endorsement from the pros. While the average target price was around $5.46, the stock actually traded higher at $5.77, with some analysts even seeing potential for it to go as high as $6.80. This tells us the market was really excited, perhaps even more so than the average analyst expectation, suggesting some big news was being priced in. Now, a quick technical note. While the stock showed strong upward momentum, its relative strength index was at 79 points. For those who follow technical analysis, that's considered overbought, meaning it might be due for a small pullback. But overall, the sentiment was overwhelmingly positive. So, what's the big picture here? Why are analysts so bullish, and what's driving this company's momentum? It all comes down to a major strategic shift. In October 2024, Hong Kong land announced a bold new vision for the next decade, aiming to become the leader in ultra-premium commercial properties across Asia's top cities like Hong Kong and Singapore. Think Grade A offices, luxury retail, high-end residential, the best of the best. A key part of this strategy is moving away from what they call the build-to-sell business, basically developing properties just to sell them off quickly. This segment used to contribute about 25% of their earnings, but it was pretty unpredictable. Their goal now is to get more stable, recurring income from their investment properties, making their earnings much more consistent. They expect the build-to-sell part to shrink to less than 10% of earnings by 2027. To make this happen, they're planning massive capital recycling. That means selling off some assets and reinvesting the money. They're looking at up to $10 billion over the next decade, with about $6 billion coming from selling off their development properties. This cash will help them expand into new premium locations. They're even exploring turning some of their existing investment properties into REITs, or real estate investment trusts, which could unlock about $4 billion in value. This is a smart way to get more value out of their existing portfolio. And here's a big one for shareholders. They might use up to 20% of these proceeds for share buybacks. This is a great move, especially since the stock has historically traded below its true asset value. Citibank even raised their target price partly because of a planned $200 million share buyback. Now for the latest news. In April 2025, Hong Kong Land made a huge splash by selling some office floors and retail space in their One Exchange Square property to the Hong Kong Stock Exchange for a whopping $810 million US dollars. This news sent their share price soaring by 10%. Analysts saw this as a clear sign that their new strategy is working and will boost both their net asset value and earnings per share. This wasn't just a one-off, it was the first major step in their new capital recycling plan. Financially, despite some challenges in 2024, their first quarter of 2025 saw underlying profit in line with the previous year. They've also been actively reducing their debt, bringing it down to $4.9 billion by March 2025, and their net gearing is a very healthy 16%. Plus, 68% of their debt is at fixed rates, protecting them from rising interest costs. S&P Global Ratings even affirmed their A credit rating, which is a strong vote of confidence in their financial health. So while the Hong Kong property market has its challenges, like high vacancy rates and rising interest rates, Hong Kong Land's prime assets are holding up remarkably well. Their Hong Kong offices were 92.7% occupied at the end of 2024, better than the wider central business district. Their properties are considered trophy assets that can command premium rents even in tough times. Let's talk about what the market thinks and what this means for you as an investor. As we mentioned, analysts are overwhelmingly positive. 7 strong buys, 1 buy, 3 holds. That's a lot of confidence. The fact that the stock price has already surpassed the average target price suggests the market is really buying into this new strategy. From a valuation standpoint, Hong Kong Land is often seen as undervalued. It's trading at a significant discount to its net asset value with a price-to-book ratio of just 0.39. This means the market is valuing the company's assets at much less than they're actually worth on paper. Compared to some other Hong Kong developers who are struggling with high debt, Hong Kong Land's low debt levels make it look even more attractive. This deep value opportunity is a big part of its appeal. And finally, dividends. Hong Kong Land has a solid track record of paying dividends. For 2024, they paid out 22 US cents per share, consistent with 2023, and even increased their final dividend by 6%. For 2025, the forecast is 23 cents per share, giving a dividend yield of 3.6%. Under their new strategy, they aim to pay out 60 to 80% of their recurring income as dividends and even target doubling their dividend per share by 2035. This commitment to returning cash to shareholders is a big plus for income-focused investors. So is Hong Kong Land a good investment for you? Let's weigh the pros and cons. On the upside, their strategic shift to stable, premium properties and capital recycling could unlock huge value. They have an incredibly strong balance sheet with low debt and plenty of cash, making them resilient and able to seize opportunities. Their prime assets are top-notch, maintaining high occupancy and commanding premium rents even in tough markets. They could benefit from consolidation in the Hong Kong property market, potentially acquiring distressed assets. And their clear commitment to growing dividends is a big draw for income investors. However, there are risks. The Hong Kong property market still faces headwinds like high vacancies and economic uncertainty. Planned renovations at their landmark retail complex will impact rental income in 2025. Geopolitical tensions between the US and China could affect Hong Kong's economy. And while most of their debt is fixed, persistently high interest rates could still be a challenge. Finally, executing this big strategic shift will take time and has its own risks. So, who is this stock best suited for? Long-term value investors, if you're willing to look past short-term bumps and believe in the long-term value of prime real estate in Asia, this could be for you. Income-oriented investors, if stable and growing dividends are your priority, Hong Kong land's new policy is very appealing. Contrarian investors, if you see the current challenges in Hong Kong as a chance to buy a high-quality asset at a discount, this might be your play. Investors with a moderate risk appetite, while it's real estate, Hong Kong land's strong financials make it relatively more stable than some peers, but you need to be comfortable with Hong Kong's unique market dynamics. Those seeking diversification, it offers exposure to a well-managed portfolio across key Asian cities. Essentially, Hong Kong land is seen as a contrarian stream, a high-quality company that's been beaten down by external factors, but has strong fundamentals and a clear plan to unlock value. It's not for quick gains, but for patient investors looking for long-term appreciation and consistent income from a fundamentally sound business. To sum it all up, Hong Kong land was trending on the SGX due to a strong market and positive analyst sentiment fueled by its strategic pivot towards stable, ultra-premium properties and significant asset sales. It boasts a robust balance sheet and a commitment to growing dividends, making it an attractive buy for long-term, income-focused, and contrarian investors who are comfortable with the unique risks of the Hong Kong market. Remember, always do your own research and consult with a financial advisor before making any investment decisions. If you found this analysis helpful, please hit that like button, subscribe for more in-depth market insights, and let me know in the comments what other stocks you'd like us to cover. Thanks for watching, and I'll see you in the next video.